All right, today we are going to do something that, let's be honest, can feel a little intense. We're going to take a corporate financial report and break it down, piece by piece. And our case study for this deep dive is Arihant Capital. You know what I'm talking about, right? You open one of these things up and it's just a sea of jargon and figures. It feels like it's designed to be confusing, like you're trying to read a completely different language. You are definitely not alone. But here's the secret. Every single one of those numbers tells a story about how a company's doing, where it's been, and maybe even where it's going. And that's exactly what we're going to do today. We're going to find the story hidden inside all that data. So here's our game plan. We're going to treat this like a corporate health checkup. First, we'll check the vitals, that's the revenue. Then we'll look at its core health, which is all about profitability. After that, we'll do a full body scan of the company's foundation. And finally, we'll wrap it all up with our final diagnosis. Exactly. Think of us as doctors for a corporation. We're about to examine all the key indicators, all the vital signs, to get a really clear picture of how healthy Arihant Capital actually is. First things first, revenue. You can think of revenue as the lifeblood of any company. It's the raw energy coming in the door before you even think about paying any bills. A strong, growing revenue stream, that's pretty much the #1 sign of a healthy, thriving business.
So to be super clear, when we say revenue from operations, we're talking about the money that comes from the company's main gig, what it actually does. For Arihant, that's mostly things like stockbroking. This is what's called the top line number, and it's the absolute starting point for everything else.
And here it is, our first vital sign. In just 1 quarter, 3 months, Arihant Capital pulled in 73.7 crore rupees. That is a lot of energy flowing into the business. But where does all that cash actually come from? Well, this breakdown is super interesting. You can see that the lion's share, 58%, comes from fees and commission. That tells us their core business is absolutely firing on all cylinders. About a third comes from interest, and then a smaller slice from their investments. Okay, now get ready for this, because this is where the story gets really good. Look at these 2 bars. The one on the left, that's the revenue for just the first 6 months of this year. The one on the right, that's for the entire 12 months of last year. You see that? In just half a year, Arihant has already made more money than it did in all of 2023. That isn't just growth, my friends. That is some serious acceleration. All right, so revenue looks fantastic, but making a ton of money is one thing. What a company actually keeps after all the bills are paid, that's what really shows you its core health. That's profitability. Yep, this is the famous bottom line. You've paid your employees, you've paid the rent, paid your interest, paid your taxes. What is actually left over? In the reports, you'll sometimes see this called profit for the period. This is the number that tells us if the business is actually creating real, sustainable value. And the result for this quarter is a net profit of 17.7 crore rupees. So think about that. Out of the 73.7 crore that came in, Arihant was able to hold on to nearly 18 crore as pure profit. Now that is a very healthy sign.
And just when you thought it couldn't get better, check this out. It's the same story as revenue, but for profit. In just the first 6 months of this year, Arihant's net profit has already completely blown past the total profit from all of last year. This is huge. It means the growth isn't just superficial, it's flowing directly down to the bottom line. So far, we've looked at the flow of money, right? Income coming in, profit being kept. Now it's time to zoom out and do a full body scan. We're going to look at the balance sheet to really understand the company's solid structure. What does it own? What does it owe? This gives us a snapshot of its long-term stability. A balance sheet is actually built on a really simple idea. On one side, you've got assets. That's all the stuff the company owns that has value. And on the other side, you have liabilities. That's just everything the company owes to other people. Simple as that. And here's the magic rule. They always have to balance, based on this fundamental equation. Assets equals liabilities plus equity. So what's equity? Well, that's the real value left over for the shareholders if all the debts were paid off tomorrow. For Arihant, you see almost 937 crore in assets, which is balanced by 600 crore in liabilities and a really solid 337 crore in equity. That shows a very strong foundation. Okay, we've checked the vitals, we've assessed the core health, we've done the full body scan. It is time to bring it all together and give our final diagnosis. What's the overall story of Arihant Capital's financial health? The story the numbers tell is incredibly clear. First, we saw absolutely explosive revenue growth, smashing last year's total in only 6 months. Second, and this is crucial, that growth is super profitable, with profits doing the exact same thing. And finally, the whole operation is built on a solid foundation, with a healthy balance sheet and a lot of equity. The diagnosis? This company is in a state of robust financial health and is expanding fast.
So we'll leave you with this to chew on. This kind of insane growth is obviously exciting, but it also creates entirely new pressures. How do you scale up your operations that fast? How do you maintain quality? And how do you handle the new competition that's sure to come when you're this successful? The numbers tell an amazing story about today, but the next chapter is always waiting to be written.